Gen Z and middle-class Indian consumers are consistently trading up to more expensive alcohol. But if everyone is buying higher-end drinks, why are the profit margins of the biggest industry players completely breaking apart in the latest fourth quarter? This chart illustrates the disconnect. A smooth climb in premium demand collides with violent spikes in aluminum prices and tax hikes. One company doubled its profit, another's revenue shrank. We are examining Q4 numbers for Radico, United Spirits, and United Breweries to understand this divergence. We are going to put these three companies through a stress test, measuring them purely on their structural immunity to outside forces. To understand the actual investment potential here, we have to look past the marketing hype around premiumization and see how each business actually handles geopolitical and regulatory chaos. This pyramid represents United Spirits' demographic view, divided into three tiers. They abandoned the lowest 20% entirely to focus exclusively on the middle class and wealthy elite. This segment now drives over 90% of their total net sales. Radico Khaitan is moving with aggressive momentum. Their volume in that premium tier jumped 28%, heavily fueled by luxury single malts and craft gins. United Breweries is trailing in this transition. Even with decent growth from specific bets like Heineken Silver, their premium segment makes up less than 10% of their total portfolio. Across the board, a major driver of this premium shift is packaging. Companies are aggressively pushing 180 milliliter and 200 milliliter pocket-sized formats. These smaller options give younger consumers an affordable way to test out high-end brands without committing to the price of a full bottle. But the operational trade-off is steep. Shrinking the serving size means higher packaging complexity, and it requires significantly more glass per liter of alcohol sold compared to a standard 750 milliliter bottle. Both United Spirits and Radico have successfully aligned their business models to capture these high-margin, small-format sales, while United Breweries remains heavily dependent on shifting massive volumes of traditional beer. Zooming out, analyzing national revenue numbers in India can be deceptive because the alcohol market is actually 28 strictly controlled individual state economies. Take Maharashtra as a case study. Their recent policy aggressively hiked regular spirit prices by up to 80%, while keeping the tax increase on premium labels capped at just 10%. This localized rule heavily penalized mid-tier brands. It dealt a direct hit to United Spirits' volumes and effectively caused the state's entire alcohol industry volume to contract by 20%. However, because beer was excluded from that tax hike, United Breweries actually reported over 20% growth in the state as drinkers swapped out overpriced budget liquor for beer. Meanwhile, Karnataka took the exact opposite approach, aggressively slashing its excise tax brackets on premium spirits from 16% down to 8%. That decision dropped the retail cost of high-end bottles by 35%, creating a massive localized volume surge that directly benefited Radico and United Spirits. So a company's national quarterly performance is often dictated more by sudden, unpredictable state tax experiments than by actual shifts in consumer demand. That unpredictability extends far beyond state borders. The current conflict in the Middle East and the effective closure of the Strait of Hormuz has severely disrupted global shipping routes. This bottleneck specifically trapped roughly 9% of the world's aluminum output, sending global spot prices to a 4-year high of $3,500 per ton. Look at the sheer volume of metal required here. This is why a geopolitical shock in the Middle East disproportionately devastated United Breweries' profit margins while leaving the spirit makers largely intact. The immediate operational fallout for United Breweries is brutal. Management is projecting up to a 500 crore rupee cost impact, and margins have deteriorated so badly that they completely halted the sale of cans in Telangana. Compare that to Radico Khaitan, who managed to stay almost entirely insulated from the resulting spikes in global energy and fuel costs. Radico generates roughly 90% of its facility's power using captive biofuel, giving them massive operational independence. By generating their own power and utilizing those smaller bottle formats to absorb minor increases in glass costs, Radico maintained an industry-leading 19% EBITDA margin through the crisis. A severe macro shock strips away the corporate marketing narratives, revealing that true profitability relies directly on back-end supply chain resilience. Choosing the right stock requires matching a company's macro exposures against your risk tolerance. Radico Khaitan fits momentum investors, offering supreme efficiency and high growth for a premium valuation. United Spirits aligns with defensive investors, offering structural dominance and predictable navigation through complex state politics. They also hold a massive upcoming catalyst, the impending India-UK Free Trade Agreement, which has the massive potential to slash Scotch import duties from 150% down to 75%. United Breweries is for the contrarian turnaround investor. Taking a position here means absorbing severe short-term pain for a delayed future rebound. Keep in mind, their core premium product demand is still growing at 16%. The investment thesis is purely a bet that global aluminum supply chains will normalize in the coming quarters. While every player is targeting the premium consumer, the actual market leaders will be the ones who built their business models to survive the volatility of state taxes and global supply chains.